Hey, what's up YouTube? It's Scott with Scott Talks Investing. Welcome back. In today's video, I want to walk you through some of the differences as it pertains to retirement accounts. The three retirement accounts that we're going to discuss are 401ks, traditional IRAs, and Roth IRAs. With a 401k program, what it is it's an employer-sponsored retirement plan that allows employees to contribute a portion of their pre-tax dollars towards retirement savings. What it means by pre-taxed, if you're not familiar, is it means that the dollars are going to come out of your paycheck before they're taxed. So when you receive your, say, direct deposit from your company that you work with into your bank account, there's been taxes taken out of that paycheck already. Pre-tax dollars allows you to contribute money from your income before it gets taxed by the IRS. So there's a little bit of a boost there when it comes to taxes. We don't need to get into the details exactly, but just know that it's pre-taxed dollars. Another significant benefit of 401ks is they're usually going to have a matching program with your employer. Sometimes it can be 4%, sometimes it can be 6%, 8%. It just depends on your employer. Reach out to your HR department or your if you have like a finance team that you might discuss this with to better understand what their matching program is. Essentially what it is if they give you, say, a 5% match, if you contribute 5% of your earnings into your 401k, your employer is going to match that 5%. So say, for instance, that you're going to contribute $100 towards your 401k, which equates to 5% of your paycheck. Your employer is going to match that $100 dollar for dollar. Again, there's some nuances there, but reach out to somebody in HR for your specific situation. I just want you to understand that 401ks are funded with pre-taxed dollars. Within a 401k, you're going to be offered a selection of mutual funds, possibly target date funds. You're not super likely to be able to pick individual stocks, so there are some limitations there, but it's a great opportunity for you to get started in your investment journey towards retirement, as it's going to get dollar matched from your employer most likely. Most companies are doing a dollar matching program as of today. Jumping into the next retirement account would be what are called traditional IRAs. Another way to say that is individual retirement accounts. And these are something that you can open on your own. So this isn't going to be an employee-sponsored program. This is going to be something that you're going to open by yourself on a traditional brokerage platform like E-Trade or TD Ameritrade or Vanguard. There's quite a few different options out there for where you can open one of these, but a traditional IRA is not going to be an employee-sponsored program. Traditional IRAs offer tax-deferred contributions, and that means that you can deduct the contributions from your taxable income in the year they are made. So in other words, say you contribute $5,000 to your traditional IRA in the year 2023, and say you have an income of $100,000, your taxable income would then be dropped down to $95,000 because you've contributed $5,000 of that $100,000 into your traditional IRA account. Basically, that's just going to lower your tax bill, and you're not going to get taxed on that $5,000 that you contributed to your traditional IRA. One of the big differences between a traditional IRA and what's going to be discussed next is the Roth IRA. In a traditional IRA, you will be taxed on the money coming out at the time of withdrawal. So when let's use the standard retirement age of 65 years old, when you go to start drawing from your traditional IRA, that money that comes out at that point in time will be taxed at your current tax rate. So just keep that in mind. That's one of the biggest differences between a traditional IRA and a Roth IRA, if not the biggest difference. Jumping next into Roth IRAs, they work a bit differently than the traditional, like I just mentioned. A Roth IRA, you contribute with after-tax dollars. So when you receive your paycheck, right, it's already been taxed by the IRS, you would then contribute out of that paycheck into your Roth IRA. So using an example again, say your 2-week take-home pay is $2,000 and say you want to contribute $500 a month, that $500 a month comes from post-tax dollars. Now, there is a limit with Roth IRAs of $6,500 for the year. So just keep that in mind when you're going into your Roth IRA. You can't contribute more than $6,500 in one calendar year. One of the big benefits of the Roth IRA is when it comes to retirement age, again, using 65 as the example, that money's going to come out tax-free. So all of your earnings, all of your contributions, everything that you can contribute to that Roth IRA account over that course of however many years till retirement age, it's going to grow tax-free, and you'll have the ability to withdraw those funds without having any taxes taken out at that moment in time. So a couple things to discuss when we're looking at contributions for all of these. So there are some limits when it comes to how much you can contribute to your 401k, how much you can contribute to your traditional IRA, and how much you can contribute to your Roth IRA. So for 401ks, the contribution limit for 2023 is $20,500. You can also do an additional catch-up amount of $6,500 for individuals age 50 and above. However, keep in mind that the contribution limit may vary depending on your specific plan. So you really need to understand what's best for you and do some research on your particular situation. Traditional IRAs, on the other hand, have a maximum of $6,500, and they have for each year, and there's an additional catch-up contribution of $1,000 for individuals age 50 and above. And it's important to remember and understand that this contribution limit includes both traditional IRAs and Roth IRAs. So say you wanted to contribute $3,500 to your Roth IRA, you would only then be able to contribute $3,000 to your traditional IRA. It's a combined number in terms of how much you can contribute to IRAs in general. So to reiterate that, for 401ks, the contribution limit is $20,500 for those below the age of 50. And for IRAs and as a group, traditional and Roth IRAs, the contribution limit is $6,500 for the year. I hope you found this video helpful. If you have any questions, please leave them in the comment section below. As always, thank you for stopping by, and I wish you the best on your investing journey. Take care.